Brazilian inflation-linked bonds, IMAB5. Why foreign investors misprice one of the highest real yields in the world. Thanks for reading Solomon's Substack. Subscribe for free to receive new posts and support my work. With real yields compressed across developed markets, global investors increasingly face a trade-off between duration risk, credit risk, and inflation uncertainty. In this environment, sovereign inflation-linked bonds have regained strategic relevance, yet not all markets are evaluated with the same analytical rigor. Brazil is often overlooked by foreign allocators due to political volatility and headline-driven narratives. However, beneath this noise lies a sovereign inflation-linked bond segment offering real yields that remain structurally mispriced relative to risk. Understanding the IMAB5 segment. The IMAB5 index tracks Brazilian government bonds indexed to IPCA, Brazil's official inflation index, with maturities of up to 5 years. This segment represents the short to medium duration portion of Brazil's inflation-linked curve, offering contractual inflation protection and defined real yields. It also offers lower duration exposure compared to longer-dated bonds, and direct sovereign credit exposure, without corporate risk. Unlike nominal bonds, IMAB5 instruments preserve purchasing power by design. Unlike equities, they do not rely on earnings growth, governance assumptions, or valuation expansion. Why the market misprices this opportunity? Foreign investors often assess Brazil through an equity or FX-centric lens. This leads to an overestimation of risk when evaluating local currency fixed income instruments. 3 structural factors contribute to this mispricing. 1. Political noise versus contractual reality. While political uncertainty impacts sentiment, IMAB5 bonds are governed by explicit contractual terms. Inflation indexation is embedded in the instrument itself. 2. Duration misconception. Many investors associate Brazilian fixed income with long-duration exposure. In reality, the IMAB5 segment significantly limits interest rate sensitivity. 3. Sovereign credit versus corporate risk. The Brazilian Treasury maintains deep domestic funding capacity, reducing reliance on external debt markets. This dynamic is frequently underappreciated by foreign allocators. Relative value in a global context. When compared to US TIPS or European inflation-linked sovereign bonds, Brazilian IMAB5 bonds offer materially higher real yields, albeit with higher perceived risk. However, this risk is often priced as if duration, credit, and FX exposure were fully correlated, which they are not in this structure. IMAB5 exposure allows investors to express a Brazil thesis without equity volatility, corporate governance risk, or earnings cyclicality. Instead, the exposure is anchored in sovereign obligations with inflation protection and manageable duration. Key risks to consider. No sovereign investment is risk-free. The primary risks include fiscal policy deterioration, monetary policy misalignment, and secondary market liquidity constraints. These risks, however, are transparent and quantifiable, and should be evaluated against the current level of real yield offered. Conclusion. For investors seeking real yield preservation in a world of compressed returns, Brazilian inflation-linked bonds, particularly within the IMAB5 segment, represent a sovereign opportunity that remains widely misunderstood. When evaluated through a fixed income lens rather than political headlines, the risk-reward profile of IMAB5 bonds suggests an asymmetric opportunity relative to prevailing market perceptions. Solomon von Herkelstein, independent macro and fixed income analyst focused on capital preservation and sovereign debt in emerging markets.